Well, this week we're taking a look at the Atlantic Real Income Fund. The manager there, Arno Lawrence, fund size 63.9 million rand, almost 64 million. Inception date January 2009. TER 1.3%, Class A, and objective there is CPI plus 3% over 3 years. Cobie, just take us through the returns.
Okay, I mean, again, this is now one of those kind of hybrid funds which kind of have some equities and bonds and property and a whole bunch of asset classes in, and it's targeting a real return. So it's trying to get to CPI plus a kind of 3% level. Have a look at the returns quickly that that this fund has achieved over time, and what you'll see is that there's been some decent outperformance relative to CPI plus 3. So if your objective is to beat inflation by 3%, this is certainly a fund that have done so over at least the last 3 years. Short-term track record, so we'll obviously have to look at what happens over the longer term track record as far as this fund is concerned. Now, one thing that you kind of, Albert, that you mentioned was kind of the type of equities that you own in an asset allocation such as this. You spoke about a high correlation relative to inflation, but 15% allocation here to equities. Do you want to run us quickly through those?
Well, Cobie, we spoke about a high correlation to equities or to inflation. Now, it's probably more of a case of a high correlation to differing inflation drivers, because inflation going forward will be driven by either food or by oil or by currency, and what drives inflation changes. So as the underlying drivers of inflation changes, so do the shares that we invest in this fund. Let's say, for example, that we expect oil and energy to be a very high driver of inflation going forward. A share like Sasol, for example, can be included in this fund because it has a high correlation to the underlying driver. If you think, for example, that food is going forward is going to be a high driver of inflation, it's a bit more tricky, because ShopRite and Pick n Pay, well, not Pick n Pay as such, but ShopRite is not as highly correlated to the underlying driver of food, because it's a food distributor, or at least the final distributor of food. What does and is correlated with underlying food costs, however, is things like Zeda or Rainbow Chicken, so you can invest in those type of companies. Trying to track inflation using equities, however, is difficult, so you do tend to up and down weight your equity and to up and down weight some other asset classes, so that you can at least track inflation as closely as possible by keeping the risk and volatility in the fund down as well.
Mm-hmm. What are your thoughts on this? Because just looking at the fund and sector allocation, or asset allocation, if you could call it that, of course, while there are equities and properties make up 8.5%, just under that, it's really bonds and cash that really dominate here.
Albert, give me your view on this, but when I look at the asset allocation, I see what I would probably call quite a conservative positioning, in the sense that you have over half of the fund in sort of maturity less than 3 years. You've got no government bonds. You've got a nice chunk of inflation linkers there. But I'm just wondering if you are anticipating inflation to come through, because you're not taking a lot of risk at this stage, given that you have to try and beat CPI plus 3.
Well, it depends on where we are in the cycle as well. This fund has in the past gone up and held high percentages of and high allocations of government bonds. We trade those pretty actively. But a large part of this fund's focus is determined by the final investor, and the final investor in these types of funds tend to be conservative, and they tend to be often retired individuals. So the focus of this fund tends to be more on income provision, and equity is seen as a kicker. So we see equity and property as having that final kicker and pushing us from inflation plus 1, which you can get with bonds and cash, and adding just that little bit to get you from inflation plus 1, 1.5 to inflation plus 3. Mm-hmm. So that is the idea around structuring the fund. You could add more equity and more property and more volatility to the fund, and then probably get around to inflation plus 4, inflation plus 5. But given where our benchmark and our investors sit, we do tend to run this fund on a very conservative basis. It's not a fund for someone that wants to track the stock market. It's not a fund for someone that wants to shoot the lights out on inflation plus 7. It is a more conservative, income-focused, income provision fund for those people that want stable income and stable growth relative to inflation at around about inflation plus 3.
Albert, what are your views right now on the bond market? Because I think it's Absa Capital's views on the Orbi 1-year view of 5.6% return. We know that bonds for the past many years have been doing so well. So what are your views on the bond market going forward, and also bonds versus inflation linkers?
I think there are risks towards both sides. We have the capacity, and international investors have the capacity to flood our bond market should a couple of serious investors, whether it be wealth funds or large international pension funds or large international tracker funds, decide to come to our market. We saw close to 80 billion in inflows in bonds last year. If we see anything approaching that again this year, it's going to be probably another decent year for bonds. However, given the fact that we are probably trading in around, depending on where in the bond curve you sit, let's say between 6.5% and 7.5% yield to maturity, and inflation for the next year is forecasted to sit at around 6.5%, bonds as a whole probably is not going to give you that high inflation outperformance going forward. And where if we sat at some of the high levels that we saw last year, we would have been significantly overweight on bonds. Right now, we tend to be, at Atlanta, we tend to be range trading the bonds. Because we have such a high foreign ownership, and because our market tends to be pretty active in the, or at least foreigners tend to be pretty active on our market, it does lend itself to sometimes relatively volatile changes. For us, that gives us the opportunity to range trade some of the bonds. So we have at times been in and out of especially the government bond market, to try and take advantage of those range trades.